thank you so much for inviting me. Thank you so much for putting together this great program. I'm the last presenter, and so thank you so much for hanging out for the 2 days, and I'm joining the others in complimenting the organizers for this amazing work. So I don't know if later or now we should give a round of applause to everyone, but thanks again. And now, let's do it now, because everyone is here. And in the title of my paper, we also have the word geopolitics, which is I'm particularly proud of. And because, again, this is an important topic, as we have seen in the past 2 days. And in fact, this paper is part of a longer research agenda that Matteo and I have been working on for a few years. And 2 things I wanted to, well, 3 things. First, since this is a public event, again, I have a disclaimer that none of the views I'm expressing here are those of the Board of Governors of the Federal Reserve System. The second is that all the data I'm going to show you today related to geopolitical risk are available on our web pages. We update them in real time every month, and there is way more than I'm presenting, so please go and check them out. And third, this joint work with Sarah Conlisk and Matt DePen, 2 great research assistants at the board, was born out of a question we got in March 2022, after the Russian invasion of Ukraine, when inflation was already picking up in many countries, and our principals literally asked us, does geopolitical risk rise or lower inflation? And that's what we set up to investigate with Matteo and Sarah and Maddie, given that in previous work we had already established the real effects of geopolitical risk. And why this was an important question is because from a theoretical standpoint, the answer is not so obvious, because there are channels that connected to geopolitical risk that can push inflation up. Of course, the key being adverse supply effects with the destruction of capital, the destruction of course, the deaths, or loss of human lives, loss of trade, as we will see. But there can be also adverse demand effects, for instance, connected to uncertainty. And unclear, and that's going to be a key part of the transmission, is the role of monetary and fiscal policy. So to answer this question, we applied several empirical tools, and they are all based on an investigation of 120 years of data to establish the historical association between higher GPR and inflation. And this is not a novel. I don't need to wait all the way to the end to tell you who is the murderer. So the answer is, and geopolitical risk rises inflation. And if you want to have a picture to take away, is this simple one, where on the top panel I'm plotting the global geopolitical risk index that Matteo and I constructed in previous work, together with the aggregate global measure of inflation. As what you can see is that these 2 variables tend to co-move, where co-movements are larger in initial episodes, World War I and World War II, but also there are some spikes later on that coincide. And that's not just a phenomenon that happens at the aggregate. You can see that the share of countries experiencing higher inflation during periods of geopolitical tensions is high. So when geopolitical tensions are high, the timing varies, but many countries tend to experience high inflation. So this is the aggregate. I will go into the cross-section, and that's going to hold true as well. But this gives a flavor of where I'm going. And since we used, as Nick and many others discussed, news-based measure, we thought it would be nice also to show you, to give you a sneak peek of how newspapers cover not only geopolitical risk, but also this type of association with inflation, which is not what we exploit, but you can see well, there is Argentina and the war, of course. But there is, there is discussion of various channels that go from, again, disruptions on the supply side, fiscal responses, commodities, and so on. So this is something that where also some anecdotal evidence is clearly present. And let me jump straight into the analysis. So there has been a lot of work which we did, which was just about putting together a large data set of of historical data. We actually have two data sets, and I will explain you why. But the first is a country-level annual data set. We do that because we can go back to 1900 with our indices. And this data comprise 44 countries, both emerging and advanced economies. And we have data on inflation, real GDP, and then policy indicators. We cared about the fiscal policy response because also of work of Hall and Sargent, for instance, for the US, we wanted to expand it a bit. So we look at military expenditures, public debt, and money growth, but also trade. And just for the US, that's something recent, we want to see whether we can expand it. We constructed two news-based indicators of supply shortages. So not too far maybe from what the New York Fed has been doing, but we wanted to go back to 1900. So we tested this for the US and also of private aggregate demand. Because again, just looking at real GDP is a bit tricky to disentangle supply versus demand. So we rely on these two variables. But then to track the effects of geopolitical risk on faster moving variables, higher frequency variables, we also use monthly data on world GDP, world inflation, consumer confidence, but most importantly, in terms of propagation on financial variables, so stock prices, the dollar exchange rate, oil prices, and the commodity prices. And that's also the model we use in a note, and I will show the results, to track in real time the effects of the Russia-Ukraine war on real activity and on inflation. So we updated that analysis monthly. We have talked today about geopolitical risk, but it is a fuzzy concept. So I thought that for 1 minute, I wanted to define discuss what is the definition we adopt in our work. So we are kind of narrowly focusing on the threat, the realization, and escalation of adverse geopolitical events associated with wars, terrorism, and any tension among states and political actors that affect the peaceful course of international relations. Again, coming last, many of those things have been already discussed, is very hard to disentangle the realization of shocks vis-a-vis pure uncertainty on risk shock. So these indicators tend to capture both. In fact, we think of our index as capturing higher the current intensity of negative adverse geopolitical events, the higher probability, so having a news component as well, so news of future event, but also having, again, this uncertainty component. So to some extent, one advantage of geopolitical events is that we can control for the realization, and we do in several parts of our work, by having either dummies or indicators that specifically are timed to be spiking when events materialize. So you can think of the war, the invasion is an example. There were news about the potential invasion of Russia and Ukraine in the months leading to the war. So that was kind of a news, threat, uncertainty component. Then the war erupted in February, on February 24. We can control, or we can add a variable that captures that, and we can do it more systematically. So at least the realization can be taken out when considering more of a pure news uncertainty type of effect. And I'm not going to go through the construction because it follows what Nick discussed yesterday. We scrape newspaper articles and we look at the frequency of articles mentioning geopolitical risk. There is a lot of work underlying the term selection, the search terms, the validation, because we go back to 1900, so the language usage has changed over time. The way articles and newspapers are formatted was very different. We have a very lengthy appendix. It's way longer than the paper with the AR, so it's all in there. You need to trust us on that. But this is the historical global geopolitical risk index, just to give you a sense of an initial set of data. And what you see is that, of course, you can recognize spikes and persistence of the index around key episodes in history, like the 2 world wars, but also the Korean War, the Cuban crisis. So some of our events overlap also with Nick, but there is also independent variation. And one other thing that it's interesting or well, two things that are relevant for the analysis is that first, some of these events can be related to economic activity, but the predictability is less of an issue, or the correlation with the cycle relative to, say, economic uncertainty for many episodes. And the other is that due to the spiky nature of these events, political leaning of newspapers or the way the coverage is done, that doesn't really matter. I mean, when there is a war or when there is a terrorist attack, there is coverage. We even look at front pages of newspapers, the coverage is there, period. And the volumes go up a lot. So it's very robust on all the details of how you implement the construction of the index. Going back to the analysis, we use a panel dimension. So what we do, because we don't have the great resources that Nick and co-authors have to use foreign language newspapers, we slice the global index. So we use English-speaking newspapers, and we slice that index by searching within our pool of articles for articles mentioning the name of a country, the capital city, or other words that are commonly used to refer to a country, to then slice the index by country and obtain our 44 indices, which are also validated using very similar methodologies. And here I'm plotting some examples, some of those, together with inflation. So and this is to iterate that the relationship I showed you holds not only at the global level, but also on a country level, and not only for World War I and World War II, which is the main concern that many people have with this type of analysis, but also for emerging economies for other episodes. Here just an example for Indonesia and Thailand. Advanced economies, of course, there is the 70s, is a big example of spiking inflation associated with geopolitical risks. So this is another picture that, if you want to remember, please do so. And it's the simplest possible regression we run is a two-equation panel VAR model with just geopolitical risk and inflation. And the reason we do it is because the coverage for the other variables is very, well, you get an unbalanced panel when we want to use all this data especially for emerging economies, while with inflation, thanks to Reinhardt and Rogoff and the World Bank and so on, we can put together a balanced panel. So this is the VAR that uses all available observations we have in our panel. And what you see is that when you have a one standard deviation increase in geopolitical risk, inflation goes up. So there is on year one, there is an initial spike, and there is then some persistence in its effect. So that was the answer we gave to our principles. Now, inspecting the transmission mechanism, we added to the model some variables, and if we had to think about the demand versus supply component, just judging from this picture, we think that is the supply component dominating the transmission, because you have a negative co-movement. So when you have a GPR shock, you have a negative co-movement between inflation and GDP. And also there is this trade component that, especially back in the days, was particularly could be particularly relevant even now. But you have a clear decline in trade, which again can be, supply chain bottlenecks and so on. Very trendy now, but also back in the days when you had world wars and so on, trade collapsed. So that's something that we find, and strongly so, in the data. But there is also a policy response, and that's also related to the work of Tom Sargent, where you see that, of course, when you have geopolitical risk, many countries tend to increase military spending. That's not surprising. And that financing goes through debt, but then it goes also through money growth. And inflation is part of the financing when talking about expropriation before, another way for governments essentially to expropriate private resources, and that's, again, discussed at length in other papers, is just let inflation run and you repay your debt, just inflating it away. Which it happened especially for some countries and the US as well. I think it was World War I in particular. Here is where, if I would be fired if I was in Minnesota or at the Minneapolis Fed, because I'm running policy counterfactual, but I hope I can be forgiven. I write it. It's Luca's critique is pervasive here, but just from a strictly accounting point of view, what we wanted to kind of convey is that the policy response matters. So here in blue, I'm plotting the impulse responses to a GPR shock in our baseline model, and the dashed red lines is when we shut down the response of the policy variables to the shock. And it was reassuring to us that when we do that, inflation goes up by less and declines more quickly, but then you immediately see the trade-off because activity goes down by more. So if you try to stabilize, even if the only thing you're doing is trying to stabilize the economy, of course, if you want to reduce the inflation effect, you're also going to... Now, this is Luca's critique 101, because of course, if you're in a war, you're not going to not increase military spending, especially if you do it so persistently. But it gives you a flavor of what's going on, and also this impact effect is interesting because we think it's also related a lot to the destruction of capital and to other channels where we have not so much of a good proxy in the data. Then we also looked at cross-country heterogeneity, and that's the part that maybe was not in the version we forgot to upload. But right now, up until now, the elasticities to geopolitical risk were common across all countries. So what we do in this very simple exercise is that we run some panel regressions where on the left-hand side we have our outcome variables of interest, inflation, military spending, debt, and trade, 3 years ahead, because that was kind of roughly the peak of the response in the panel var, and then we run a regression on country fixed effect and the country-specific indices. And what I'm plotting here? On the y-axis, I'm plotting the country-specific betas for inflation. And what you can see is that the effects are dispersed, although most of them are, let me try to use this fancy tool, look at that, are centered between 0 and 5%. This works beautifully for this specific chart. Even though you have a lot of heterogeneity, there is this cluster around 2 to 5% response of inflation. On the y-axis, I'm plotting the betas for, say, military spending, and then I'm looking at the correlation between inflation and, say, the response of military spending for a country. So what you see is that for a similarly sized increase in geopolitical risk, for countries experiencing a larger increase in military spending, you also see that inflation goes up by more. And that's super strong, super robust. Japan here is terrible. We can remove some of the outliers it holds. And it's true for military spending and for trade. We don't find, at least in this very simple exercise, much of a relationship for that. But again, that is a tricky variable because, again, how much debt you can hold and debt positions of a countries are determined by so many factors that maybe it just doesn't all go in the same direction. GDP is another variable where the correlation is pretty strong. I don't have it here. Then we look at the US, and the reason why we look at the US is that US has a unique experience with geopolitical risk. It's involved in all major events of the past 100 years, but it never experienced anything on their soil, except for 9/11, but in terms of a direct impact on GDP is very tiny. But it's also a country for which we have a ton of variables available, for instance, these text-based indicators. And also, we really wanted to delve a bit, as we did in the other paper, in the relationship between our index and the military news data of Valerie Ramey. We argue we have additional, like with APU, there is additional information content in our indexes, and that's what we kind of show also here. And so this is the response of the US economy to a one standard deviation GPR shock. And on policy, the response is similar. The key difference is GDP, and that's driven by World War II in particular. So in World War, because in World War II, essentially the US funded the war, the war effort of many European countries, and so like industrial production went up 25% for a couple of years, and then you see that in fact for the US, when you look at the whole sample, GDP goes up. When you focus on the last 40, 50 years of data, where instead is the uncertainty channel that dominates, GDP goes down actually. Not much, but it goes down. And the other thing is military spending goes up, news about military, so it's not only the realization, so it's very, it lines up pretty well. News go up immediately and they materialize later. So kind of the story holds on together, but this index of shortages goes up, so there is some evidence of shortages, but there is also evidence, which is harder to pick from GDP, that private aggregate demand also softens. So for the US, we think we have a one picture to describe most of the channels we wanted to discuss. In terms of robustness, two things I want you to take. So here we run robustness. Now, our variable is spiky, inflation is spiky. So we wanted to do two things. One is robustness to first control for the global component of GPR. I wanted to convince you we have heterogeneous effects, but most of these effects are, most of the spikes are common across countries. So we add our global GPR as a control. And when we do that, relative to the baseline coefficients, the coefficients on the country-specific GPR are attenuated, but they are still significant. So number one. We also find that for the full sample, both advanced and emerging economies are hit by GPR shocks. So inflation goes up by a similar magnitude. So there is no particular difference. And if we exclude the two world wars, effectively, we still have an effect of geopolitical risk on inflation. Now, we still call it geopolitical risk index. So we looked at that also in the other paper for other variables, but for inflation is also true. So when we run panel quantile regressions, and here I want you to take two results from the bottom part of the table. The first is the median effects are similar to the OLS effect. So of course there is some difference because the distribution is skewed, but it's not a crazy difference. So if you only care about median effects, and you are worried about outliers, yes, of course, this distribution is going to be skewed, but not terribly different. And the second is the relationship is most tilted to upside risk on inflation, and that was to be expected, but there is, I'm sorry, the columns denote the time dimension. So these are quantile regressions with inflation at time t plus 1, t plus 2, t plus 4, t plus 5. So what moves a lot is the 90th percentile of the inflation distribution. So it's the right tail of the inflation distribution. So GPR is shifting the distribution of inflation, blowing it up. So there is uncertainty because also on the left-hand side you have some, but it's also creating upside risk to inflation. So that's what we wanted to show here. Finally, on something on the Russia and Ukraine war, I don't have much time to go through this, but we use the monthly VAR to look at the inflation effect of the Russia-Ukraine war, and there we needed to rely on these more granular measures where we distinguish between the threats, so the news component, and the acts. And the reason is variables like commodity prices, oil prices started to pick up before the war. So, even gas prices started to go up before. So, and the threats is what really is correlated with these fast-moving variables. When the acts happen, most of the time the variables are already at kind of peaking and they're actually declining later. So if you were, it's like the Ramey argument. If you don't look at the news and you only look at the realization, you might be biasing massively. You might think actually the effects go the other way around. So we needed to distinguish these two dimensions for this exercise. And then in simple terms, we estimate a VAR up and the results are out. Well, I'll show you. Up until, so we did this in May, and we have a note on that. So we used data up until April 2022. We extracted the geopolitical risk shocks that materialized between January and April. And then we ran a forecast conditional only on the geopolitical risk shocks that materialize in those 4 months. And those were the effects we documented. So, of course, we do this in deviation from Q4 2021. So our prediction at the time, which is out there in a Fed note, is that world GDP, so because of the Russia-Ukraine war and all the risk associated to it, world GDP will decline by 1.5% relative to a no-war baseline. And inflation, global inflation will go up by 1.5 2 percentage points. I want to update this chart to show the realization, and inflation went up by much more, so it was like 4.5 5 percentage points. That's fine. There were other factors. GPR is maybe 1/3 of it. And world GDP, I think, maybe softened by less because there were all these massive aggregate demand stimulus that were injected in the economy. But this was the forecast at the time. And this chart is giving you the effects, the peak effect, sorry, the 1-year effect of the variables we have in the VAR to the same scenario. So this is essentially the 1-year impact, the trough roughly of GDP and inflation I showed you before, but you have confidence dropping, the dollar appreciating, again, like type of flight to safety effects, but then you have also commodity prices going up and the stock price, the level of the stock market declining. This is mostly an impact effect, but on the level, that's what we find. So I'm done. And again, what you need to take away is that geopolitical risk clearly have an impact on inflation and clearly have inflation goes up. That's pervasive across countries over time, and it definitely applied to the last experience. So thank you very much.
Thank you. And our discussant is Riccardo Sabbatucci from the Stockholm School of Economics.
All right. Last presentation, discussion, whatever. But thanks, first of all, Maria Assunta and Alvin. Again, I would repeat myself following all of you, but it's been a great conference, both yesterday and today. Interesting work from both policy and research-wise. So thanks very much, everybody. So I'm going to discuss your paper, Dario, and let me first take a step back. This paper really builds on the brilliant AR paper that Dario published, and that paper was really constructing this GPR, Geopolitical Risk Index. And this paper here is a kind of a spin-off, let's say, and it's an application of that main GPR construction index on one outcome variable, which is inflation, all right? So what is the relationship between geopolitical risk and inflation? I'm not your boss at the Fed, but it's a great work, so bonus allowed. So what's going on here? So in theory, the ex ante and conditionally, right? The relationship between inflation and geopolitical risk is not necessarily that clear. Okay, so there are two kind of forces, both demand and supply forces are at play here, and some of them offset each other. And the second, I think, interesting part of this relationship is what are the transmission channel here between the actual risk realization of threat and inflation dynamics, right? You know, it could be happening through trade, fiscal or monetary policies, or through commodity pricing, depending on what country you are, right? What are the contributions of this work? First of all, establishing and understanding the relationship between geopolitical risk and inflation for a bunch of countries. And again, there are a few studies that have looked at other left-hand side outcome variable. This paper really focuses on inflation. And the second thing is highlighting through all this impulse response function that Dario showed, what kind of transmission channels really matter. Okay, that's a summary of the paper. Great. What are the findings? Using panel structural VAR. So this is basically a macroeconometrics paper, which is great, differently from some of the papers we presented were presented today. This geopolitical risk increase and co-move positive with inflation. That's already been shown, but this is the first plots that Dario showed. Lead to lower economic activity outside the US and high in the US. That's in the draft. I've seen it. And then, of course, results in an increase in public debt, money growth, and less trade with the rest of the world. And in general, the net effect on inflation across different countries and different time periods as well is positive. Okay? And I think it was maybe there were a lot of variables shown by Dario, but I think one of the key variables is being commodity pricing. This is the exchange rate appreciation. The dollar appreciates, all other countries are in trouble, and that's really what causes inflation to spike ex-US. Okay, right. So I'm going to have a bunch of comments, mainly really two big ones on the ideas that could be an application that could be done to not improve the paper, but to add some more meat in the paper, right? And I think let's see some of them. So first of all the panel VAR specification that Dario showed, you control for the standard or some of these aggregate country-specific characteristics. Debt to GDP, GDP per capita, military expenditure, a very important variable, as Valerie Remy also showed. But when I was reading the draft, one thing that I really thought about is, could we think about other country-specific time-varying variables that track somehow the dynamics of firms and household individuals within a country, drive the response to GPR? Let me explain what I mean. Okay, you might have two countries, think about Italy and Germany or Italy and Sweden, which for some reason might have the same GDP per capita. But then the composition effect of these countries in terms of people or firms might cause a differential effect of the shock and geopolitical risk in the spread of inflation within the country. Okay, and what kind of characteristics I have in mind? In general, it could be education level, could be whether the country is a services economy versus a manufacturing one, wealth heterogeneity within the country, real wages, inflation expectation. Okay, maybe this is driven by risk aversion, perhaps, and employment rate. There are a bunch of differential differences that within country can still have a differential effect on the shock on GPR. And the same things, and this would be the demand side, okay? This would be the demand side of response to GPR shock. How about the supply side? Think about different countries might have the distribution of firms different. You know, Sweden has usually smaller firms than Germany. Price setting stickiness, right? You know, you can adjust prices perhaps in some countries, and therefore the supply component of inflation is not necessarily related to aggregate variables. Industry composition, the network, customer supply network, different countries, and so on. Now, why I'm mentioning this? Because these are time-varying structural characteristics of countries which are not necessarily, and definitely not easily, determined by short-term fiscal policy. You cannot really affect this easily, okay? And therefore, in other words, there could be some omitted variable type of effect in this VAR that could be controlled for. And I'll give you an example. Now, I'm Italian, but I'm also Swedish right now. And if I can think about two effects here to play, just to give you a working example, right? Italians are more risk-averse than Scandinavians, for sure. Now, we save much more. Scandinavians go on leverage pretty high. And therefore, Italians might cut their consumption much more than Swedes following a GPR shock. But at the same time, Italy has many more manufacturing facilities in terms of industrial production within the country than in Sweden, and therefore the price of final goods might counterfeit that, right? So the idea is that the final effect, the net effect, is positive, but it would be great and very interesting if, of course, with some grain of salt, in the sense that some of these data are not available in the cross-section, right? But for those countries for which you could control some of these variables, it would be very great to understand whether the VR estimation and impulse response function could be disentangled even further, right? What subcomponent of that characteristic really drives? Is a special component of demand, is more supply, or some subset of supply forces that drive this? And I think this would be, from an economic point of view, an excellent, also for monetary and fiscal policy. I mean, you know exactly what to target given the kind of composition effects within countries, right? The second component comment I have here is about relationship with other measure in a broad sense, okay? So the AR paper already does some of these, shows the co-movement with other standard measures of uncertainty, NICS, EPU, the BICS, macro uncertainty of Sydney, Ludwigson, Coros, Serena, and so on. And they, perhaps co-move somehow, probably they do. Now, this is also similar to the comment I had for Russ. One way of dealing with this, you can technically in the econometric specification, you cannot add all of them because you can't, together with fixed effects. But what you could do, you can orthogonalize that shock, right? So in other words, you could take the GPR components orthogonal to this variable, and you can try different specification here, take the residual and use that in the simulation in the VAR. And this what give you a cleaner lead-lag relationship generated by a pure country-specific GPR shock orthogonal to other potential characteristics, right? This would be really very important. You basically get a closed-end economy, right? You basically abstract all the interconnectedness amongst the countries. And then, of course, most of the paper is done at the monthly frequency, but then inflation is forecasted at the yearly horizon, so you have all this great pattern over here. And I think there's going to be a lot of more work to be done, not perhaps in this paper, but in other following work, where you can look at the higher frequency dynamics of this shock, right? That could be on deposit rates, exchange rate. You have done this, but there are a lot of other things that can come to mind, right? And this, I think, is using this grade index on different outcome variable at different frequencies is quite useful. A bunch of minor comments, but I would like to focus on one. Now, in asset pricing or forecasting, which I've done some work on, it would be great to anticipate that, right? So here's the thing. You use the realization or news-based realization through this index, GPR index on inflation. But what if I would be able to forecast that? And then I can think about an asset pricing application, portfolio allocation, policy dynamics, and so on. If I'm able to forecast this, and given the estimates from AVR or any other estimate, then anticipate the effect on other real outcomes, okay? Inflation, exchange rate, and so on. I can trade on that if I'm an asset pricing, or think about what if I believe that China is going to attack, and this is maybe a strong word, but Taiwan by the end of this year, and then I know that GPR will increase, and perhaps I'm able to use this information in a better forecasting model, right? This is forward-looking dynamics within a model. Now, again, this is a great, useful paper. It's an application of this brilliant GPR index that Dario and Coros developed in the past. It's very useful to complement standard inflation forecasting model. Perhaps another thing you could do in appendix is understanding also the relationship with our existing forecasting model for inflation. And I really look forward to the next version, and good luck with the paper.
Dario, would you like to take a moment to respond to the
Just one moment, because the discussion was great. I agree with many of the points, and you almost laid out a research agenda. And so our hope, and I think to some extent it's happening, is that some of the questions and some of the ideas are developed by others. I mean, that's essentially the reason why we provide this as public good. Some others we are going to do. The only two things I wanted to mention is, just to avoid any confusion, we looked at inflation so carefully because first we thought it's an important policy question that needs to be documented. Second, because we didn't do it at all in the AR. So somehow, well, with all the iteration on that paper, as you might know, this thing, we didn't think about inflation. So that's why we rushed to do this when the war started. Third, this is what I do for work, essentially. So my entire work at the Fed is, we are in the modeling team. We use DSG models. We use this type of models precisely to construct scenarios. So this is what we did on the onset of the war. This is what we will be doing if done this. So this is fantastic. It's exciting. And for asset pricing, again, I don't know, but by all means, for all the asset pricers in the room, if you think this is useful, let's do it or do it. So I completely agree, and thank you so much.
Do we have any questions or comments from the audience? Yes, Nick?
Yes, I thought it was really fantastic. So, as you know, I'm a big fan of the work. I'm going to ask you a question that Andrea asked a bit of Camilla earlier, which is it's just a generally hard question. I get asked this a lot, which is basically distinguishing first and second moment. So I think of in IV terms, you have a great, it's exogenous. Actually, you're in really good shape because I think your shocks are pretty exogenous. But it's more the exclusion restriction that's the tricky thing, because you have a second moment shock, but the problem is it's correlated. I have the same thing all the time, actually. It's the word risk. You could have called it geopolitical events. Yep. And then you're thinking of like, it's both. You can look at like stock returns and implied vol, which you can actually hear it slightly harder. And it's not a criticism in particular, and the inflation results are valid. It's just, what's the channel? I think you basically, like a lot of the stuff I look at, you have like a first and second. It's like bad news and uncertainty in one bundle. They just happen to come together, and it's hard to split them out. So that's more of a rant Like,
yeah,
you
that's
know,
fine.
I've self-inserted myself as a discussant, so I'll step down at this moment.
Do we want to, if there is, is there any other question, or should I first answer Nick? So, you know, it's our part of our life. We will go to therapy. I think one of the useful, that's why your conferences are also useful. We will go through this together every once a year. No, but besides that, there is a, so for us, the issue is not really the realization of the event, in the sense that when we split our searches, we organize them into categories, and we come up with this threat component, which is focused heavily on news about wars or threats about the eruption, and then the acts component, which is like beginning, the war has started, or escalation. And then when we do identification, what we cannot fully, we take a stance and we say, we call a GPR act shock, a shock that moves this variable altogether. And then what we call a threat shock is anything that moves the threat and is orthogonal to acts. So that solves the realization, because probably here uncertainty goes up as well, but we bundled it as a endogenous response to the realization of event. 9/11 happens, I'm freaking out, there could be more, I call that an act. The problem is that there is the conditional mean of the distribution that is still gonna change, right? So I think there could, and that we are under, so what we did in the TPU paper that Andrea, the trade policy uncertainty paper that Andrea so gently advertised, we use a DSG model. I mean, we wrote a fully fledged model where we have first and second moment, like we have news shocks and uncertainty shocks. And we try to match the overall effect from the VAR using both, essentially, and then we shut down the news component and we look at the uncertainty component. And when we do that, we find that in that paper, for instance, 1/3 of the overall effect we found for trade policy uncertainty was pure uncertainty, and about 2/3 was actually news that then might or might not have been realized. So we use theory to do that.
When you started your analysis, you showed us there could be any effect on inflation, could increase, could decrease. Then you say, let's see what the data says, and you found some effect. How do I know that this is the real effect? There is no theory behind it. There is just a finding.
Yeah.
Maybe combination of other factors will generate the opposite effect. So I don't know that what you find really tells me the effect of geopolitical risk on inflation, except that this is what we find with the data. Theoretically, you didn't show us that it should be the case.
No, I agree. This is a purely empirical paper, so you need to believe our. Measurement is the key here. Measurement together with this notion that of exogeneity to the extent of saying, and that's where controlling is tricky. So what?
I believe you.
Yeah. Okay.
You pose the question: what would happen if there is a
don't have a
China
model,
attacks
yeah.
Taiwan? How do I know? There will be an increase in geopolitical risk. How do I know that it will raise inflation? Maybe it
I
will
think
lower.
Cecilia wants to.
Yeah, but I think that Jakob's point is just, look, you showed us it's not how it does, it's how it did. It's like-
Yeah, exactly.
so geopolitical
That's what I was
risk
about to say.
has
It's
increased,
historical. It's based on
and now
historical
the
experience.
Can you tell us what will happen if geopolitical risk increases when China attacks?
If I can, well, the answer I will give is I can tell you based on historical experience.
I think like what Jakob is pushing you towards, it's like maybe if you were to use a model,
Yeah,
then
yeah,
you
exactly.
could kind of figure out which
Exactly.
channels are
No,
more likely to be
that's why.
active based on
I'm totally on board with that. And right now it's on a story. And in fact, another thing we did, of course, we didn't publish, is not really for, when at the onset of the Russia-Ukraine war, we predicted, and Torbjorn, I think yesterday, had a sort of flavor of that type of thing, right? We looked at what was the prediction of our GPR on oil prices, on consumer confidence, and for instance, at the onset of the Russia-Ukraine war, consumer confidence, especially in Europe, collapsed more than historical experience. Or you had an initial increase so that would have told you that probably, and that's what, for us internally, we added to like a scenario 2, where we said, well, this time is different along these dimensions. So we were capturing the co-movements, but quantitatively we had these regression errors that were showing up. And that's, you're right. Then And that's where the theory comes in, and that's what we did for trade policy uncertainty. We wrote a fully fledged model with importers and exporters, with trade cost, and discussed at length the transmission channels of uncertainty and news. So I totally understand the point. Thank you.
Well, thank you for all that excellent comments and questions for the presenter. Now I'd like to invite Mario Sunta up here for the closing remarks of the conference.
Yeah. So okay. So thanks a lot, everyone, for coming. I had a great time. I hope you had a great time again. I really appreciate that you all traveled from far to come here, and I hope to see you soon and enjoy the sun in Stockholm. So thanks a lot.